Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Financial Statements and Ratios. Understanding financial statements and ratios is a fundamental aspect of strategic financial planning, crucial for aligning business goals. Financial statements provide a snapshot of a company's financial health, while financial ratios offer insights into various facets of the business's performance. Mastery of these tools is essential for making informed decisions and developing effective financial strategies. Financial statements are comprised of three primary components: the balance sheet, the income statement, and the cash flow statement. The balance sheet presents the company's assets, liabilities, and shareholders' equity at a specific point in time. This statement adheres to the accounting equation: assets equals liabilities plus shareholders' equity. By analyzing the balance sheet, stakeholders can understand the company's financial position and its capital structure. For instance, a high proportion of debt relative to equity may indicate financial risk, while a substantial asset base might suggest a robust financial foundation. The income statement, also known as the profit and loss statement, details the company's revenues, expenses, and profits over a specific period. This statement highlights the company's operational efficiency and profitability. Key metrics such as gross profit margin, operating profit margin, and net profit margin are derived from the income statement and are pivotal in assessing the company's ability to generate profit from its operations. For example, a declining net profit margin could signal rising costs or decreasing sales, necessitating strategic intervention. The cash flow statement provides a comprehensive view of the company's cash inflows and outflows over a period. It is divided into three sections: operating activities, investing activities, and financing activities. This statement is crucial for understanding how the company generates and uses cash, which is vital for maintaining liquidity and solvency. Positive cash flow from operating activities indicates that the company can sustain its operations and invest in growth opportunities. Conversely, consistent negative cash flow might raise concerns about the company's long-term viability. Financial ratios are derived from these statements and serve as powerful tools for performance analysis, benchmarking, and strategic planning. Ratios can be categorized into liquidity ratios, profitability ratios, leverage ratios, and efficiency ratios. Liquidity ratios, such as the current ratio and quick ratio, measure the company's ability to meet its short-term obligations. A current ratio above 1 indicates that the company has more current assets than current liabilities, suggesting good liquidity. However, an excessively high current ratio might imply inefficient use of assets. Profitability ratios, including return on assets and return on equity, assess the company's ability to generate profit relative to its assets and shareholders' equity. High ROA and ROE values are indicative of efficient management and strong financial performance. For instance, a company with an ROE of 15% is generating 0.15 cents of profit for every dollar of equity, which could be compared to industry benchmarks to gauge relative performance. Leverage ratios, such as the debt-to-equity ratio and interest coverage ratio, evaluate the company's financial leverage and its capacity to meet debt obligations. A high debt-to-equity ratio may suggest aggressive borrowing and potential financial risk, while a low ratio could indicate a conservative capital structure. The interest coverage ratio, calculated as earnings before interest and taxes divided by interest expenses, measures the company's ability to pay interest on its debt. An interest coverage ratio above 1.5 is generally considered safe, indicating that the company earns sufficient income to cover its interest expenses. Efficiency ratios, like inventory turnover and accounts receivable turnover, analyze how effectively the company utilizes its assets. A high inventory turnover ratio suggests efficient inventory management, while a low ratio may indicate overstocking or obsolescence. Similarly, The accounts receivable turnover ratio measures how quickly the company collects payments from customers. A high ratio signifies prompt collection, which is critical for maintaining healthy cash flow. To illustrate the practical application of financial statements and ratios, consider the case of Apple Inc. In its 2022 fiscal year, Apple reported total assets of $351 billion and total liabilities of $287 billion, resulting in shareholders' equity of $64 billion. The company's income statement revealed a net income of $94.68 billion, reflecting strong profitability. Apple's cash flow statement showed positive cash flow from operating activities of $122.15 billion, underscoring robust cash generation. Analyzing Apple's financial ratios provides further insights. The company's current ratio was 1.07, indicating adequate liquidity. Its ROA and ROE were 26.5% and 147.7% respectively, highlighting exceptional profitability and efficient use of equity. The debt-to-equity ratio stood at 4.48, suggesting significant leverage, while the interest coverage ratio was a healthy 45.3, reflecting the company's ability to comfortably meet its interest obligations. Apple's inventory turnover ratio was 39.4, indicating efficient inventory management, and its accounts receivable turnover ratio was 16.8, signifying effective collection practices. These financial metrics demonstrate how financial statements and ratios can provide a comprehensive understanding of a company's financial health and performance. By analyzing these indicators, stakeholders can make informed decisions about investments, strategic initiatives, and risk management. In strategic financial planning, aligning business goals with financial performance is paramount. Financial statements and ratios serve as the foundation for this alignment. For instance, a company aiming to expand its market share may focus on improving its profitability ratios and liquidity to ensure it has the resources to support growth initiatives. Conversely, a company seeking to reduce financial risk might prioritize decreasing its leverage ratios and enhancing its interest coverage ratio. Moreover, benchmarking against industry peers is an essential aspect of strategic financial planning. By comparing a company's financial ratios with those of competitors, stakeholders can identify strengths and weaknesses and develop strategies to enhance competitive advantage. For example, if a company has a lower ROE than its peers, it may explore ways to optimize its capital structure or improve operational efficiency to boost returns. In conclusion, understanding financial statements and ratios is crucial for strategic financial planning and aligning business goals. Financial statements provide a detailed view of a company's financial health, while financial ratios offer valuable insights into various performance aspects. Mastery of these tools enables stakeholders to make informed decisions, develop effective strategies, and achieve long-term business success. By analyzing financial statements and ratios, companies can identify opportunities for growth, mitigate risks, and enhance their competitive position in the market. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.